you don't pick stocks, you pick companies.
Yeah, but when I was 11, I picked stocks. I had the whole wrong idea. I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read everything. And I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, and I realized that I was doing it exactly the wrong way when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded, but I became an owner of a business, and I did not care whether a stock went up or down the next day or the next week or the next month or the next year, and I didn't have any idea what it would do. I didn't know what the stock market would do, but I knew businesses.
With even 1,000 shillings, you can invest your money and have it grow. The stock market is a platform where the seller and buyer believe they are both right. One believes he's selling high, the other believes he's buying low, all with the aim of making profit. A stock market is a financial marketplace where you as an individual, institutions, and companies buy and sell ownership of shares of publicly traded companies. If you've heard of stocks, a share is also a stock, and it represents ownership in a company. When you own shares of a company, you essentially own a portion of that company. These ownership shares are divided into smaller units that can be bought or sold by individuals and institutional investors in the stock market. Through the stock market, companies raise funds for growth by selling shares to investors that is a part of their company. When a company issues shares in an initial public offering, it receives money from investors in exchange for ownership stakes. This capital can be used for expanding operations, investing in new projects, research and development, or paying off debt, all contributing to the company's growth. IPO, initial public offering, means that the shares of the company are being offered for trade for the first time publicly. Something to note about share prices: they show the value of a company and what people think about it. Share companies are indicators of a company's perceived worth and investor statement. When prices rise, it suggests confidence in the company's future prospects. Falling prices may indicate doubts or negative expectations. These fluctuations are influenced by factors like financial performance, market conditions, and news reflecting the company's perceived value. If there is a negative news concerning a certain company, there is a high probability of the company's share price reducing. Imagine a company, let's name it X, is publicly listed in the stock market. Then news gets to the public that for 3 months now, Company X has not managed to pay its employers. This is a sign that the company is having a negative cash flow and is not able to manage its expenses. In such a scenario, there is a high probability that most of the shareholders will start selling, and they will sell low, wanting to dispose the shares to avoid having the company collapse while they are still holding the stocks. People who own shares in a company often have the right to vote in company decisions like choosing board members or approving major changes. Stock market performance can tell about the economy. The performance of the stock market often reflects the broader economic landscape. Rising stock prices are typically associated with a strong and optimistic economy, while declining markets can signal economic concerns or uncertainty. Investors often monitor stock market trends as an indicator of economic health and investor statement. Investing in the stock market helps people create wealth and get income, but it also has its own risks. When you invest in stocks, there are two primary ways to make money. That is through dividend income and capital appreciation. Dividend income. It is when a company shares some of its profits with its owners, the shareholders. It's like a bonus or reward for owning part of that company. Think of Company B, which made a profit of shillings 200,000 and decided to give a total dividend of shillings 50,000 to its 5 shareholders. If the total number of shares of the company is 100, then dividends issued will be 50,000 divided by 100, which gives us 500 shillings per share. If person A owns 30 shares, he will get 30 multiplied by 500, which is 15,000 shillings. That is how dividend income applies in the stock market. Capital appreciation. This is where buy low, sell high is applied. I know you've heard it a couple of times. Capital appreciation means making money by selling shares for a higher price than you paid for them. It's a way to profit from rising value of your stocks. It occurs when the value of your stocks increases over time. For example, when Company B went public, one share traded at shillings 0.05. After 5 years, they appreciate and a share ends up trading at shillings 30. If a person A bought 1,000 shares at initial public offering, meaning the first time they were sold at shillings 50, he could now sell them at shillings 30,000 and make a profit. Probably you're now asking how much money you need to invest. To invest in the Nairobi Security Exchange, you need a minimum number of shares, which is 100. Thus, the money you need to get started depends on the stocks you want to buy. For example, if you want to buy from Company A, which is trading at shillings 500 per share, this means to buy 100 shares, you will need 50,000 shillings. At the same time, if Company B is trading at 2 shillings per share, this means you will need to get shillings 200 to buy B shares. Join me next time as we explore on how to start trading in the stock market. Till next time on Financial Literacy, have a lovely week.